Are we heading for another financial disaster? With market uncertainty rising, many investors are asking a question: how do I protect my portfolio? In today's video, I'll show you exactly how to safeguard your investments and position yourself to profit, just like the smart investors did during the past crisis. Now, in the past 2 decades alone, we've seen multiple financial crises. We had 2008 market crash in the property market. It wiped out billions. COVID-19 set global markets into chaos, and now geopolitical tensions and shifting economic policies are causing new concerns. As new policies are coming out from the White House faster than we can evaluate, a lot of investors starts to worry about the next steps. And when we look at the turbulence in stock market, a lot of people start to predict the next big crash. But every crisis in history has also been an opportunity for those who knew how to navigate it. I recall 2020 spring when in March I managed to invest additional 20,000 euros just because market crashed suddenly and I had my opportunity reserve full at the exact moment. We know how quickly market grew after that. But what normally happens in the time of a crisis? Well, majority of investors normally start to sell the moment they see the reducing prices. And as they see the assets dropping further, they think this is the great choice and I've made a good decision. Now, the real problem appears as the market reverses and starts climbing back. Majority of investors convince themselves that this is temporarily move and the real crisis is still ahead. By the time they have enough courage to buy in, the market is already recovered and potentially at a higher level. So they end up selling at a loss and buying at increased price. This is the most common example of the first crisis for any new investors. Now let me try to fix this. How you can stay ahead of the curve and make smart decisions during the crisis. Well, let's cover this in 5 exact steps. Let's go with number 1. Build an emergency fund. As simple as it sounds. Now imagine this. The market crashes, your stocks are down 30-50%, and you need cash. What's the worst mistake you could do? Sell at the bottom. The best investors always keep 6 to 12 months of cash reserve, so they never have to sell at a loss. This is the simplest way to survive any crisis. Majority of times, I look at emergency fund through these parameters. Low risk, low liabilities, at least 3 months. And 3 months not salary, 3 months of necessary expenses. Medium risk, medium liabilities, around 6 months. Now, if we go to high risk and let's say high liabilities, up to 12 months, but no more than 12 months of necessary expenses. So if you don't have any liabilities and you work a steady job, 3 months is enough. But if you are running a business and looking after your family and got people depending on you, like kids or parents, 12 months is sort of a must. Step 2 is adjusting the risk with age. This is the glide path method. As you get closer to financial independence or retirement, your strategy should shift. This is super popular strategy and it's called the glide path approach, where you gradually reduce stocks exposure and increase safer assets like bonds or diversified ETFs. For some, this decision will not depend only on a year, but on actual financial independence level. I cover this in other videos, so feel free to check them out. Okay, let's go to step 3. Geographical diversification. Don't rely solely on the US. There's an old saying, don't put all your eggs in the one basket. Many investors only focus on the US market, but what if the next decade favors Europe or emerging markets instead? A well-balanced portfolio could look like, I don't know, 50% global ETFs, 25% European ETFs, 15% emerging markets, 10% alternative assets like real estate or crypto. Or you can focus on one global ETF, which initially counters the diversification by adjusting based on the market cap. This way, you're not betting on everything on one economy. Now, there's a lot of strategies here, but avoid being only in individual stocks, which can destroy your portfolio without warning, and being just in one economy. Now, step 4 is important because you have to invest in your income increase as well. One of the most overlooked strategies for financial stability during a crisis is increasing your earning potential. Now, while cutting expenses and savings are really important, growing your income provides a more sustainable way to build wealth and hedge against downturns. Obviously, there's multiple ways to achieve this. We have skill development, we have investing in education or certifications that increase your value in the job market overall. We also have side hustles like starting a small business, freelancing, or monetizing a hobby. And we can always invest in passive income streams. This could be through rental properties, dividends, or creating digital assets that generate certain amount of money and initially long-term income. Now, the idea here is the more financial flexibility you have, the less you rely on short term market conditions. A strong growing income allows you to take advantage of investment opportunities rather than fearing downturns. And final step, step 5, have a specific plan for what will you do in a crisis instead of reacting in the moment. Now, this is important. Most investors react to market crashes with panic, selling assets at loss or making impulsive decisions. The key to avoiding this mistake is having a predefined plan so you can act rationally rather than emotionally. Here's an example of a structured crisis strategy. First of all, you define market drop triggers. Decide in advance at what market drop percentage you will take some specific actions. For example, if it drops 10% or 5% or 15% or 20% or even 30%, maybe you'll have certain parameters how much of your money you will invest additionally. Let's say you invest half of your reserves if a market drops over 20%, and another half if it drops over 40%. Now, if this sounds difficult, the easy strategy can be as simple as I'll continue my current strategy even if a market drops 50%. So, for example, if you invest 100 euros a month, you can say, regardless of the market, even when it drops to, I don't know, 20%, 30%, or 50% minus, I'm still going to continue to invest 100 euros a month for the next 10 years. Now, by planning in advance, you won't need to rely on emotional decision making when the market is in turmoil. Instead, you'll have a clear roadmap to follow, ensuring that you emerge stronger from the financial crisis. I've noticed myself that the ones with a plan normally expect crisis and react to it with specific steps, where others let emotions take priority, which initially destroys the portfolios. So if you expecting the scenario and you know what you're going to do when that happens, it's more likely that when that's going to happen, you're going to react exactly how you planned. Now, for decades, the US stock market has dominated global returns. But is that changing? Some experts argue that European stocks are undervalued compared to the US. Emerging markets could see explosive growth over the next 10 years, and the US faces rising debt and political uncertainty. Now, all this sounds horrible, but what's the best approach? It doesn't change much from the good times. No one really knows what the future holds, but I believe in 10 years, businesses will earn more money, and we, as a whole humanity, will live better lives. So let's look at this turbulence through bird's eye and continue our investing journey with a little bit less stress. To summarize, the best way to prepare for a financial crisis is to have a strategy in a place before it happens. Build cash reserves, adjust your portfolio based on risk tolerance and age, diversify, and have a clear crisis investment plan. Investing isn't about reacting to fear, it's about making smart, calculated decisions that protect you and grow your wealth over time. Hope this video helped, and if you do want to see my portfolio in action, I have 3 separate portfolios where I invest 100 euros a month in each, so 300 euros a month, and I share that with a completely public access through the links below, with idea to show people that a simple dollar cost average investing strategy can help you build a sustainable portfolio in the long run. Have a look at this video if you want to see the details and the last overview I've done. Thanks for watching till the end. I'll see you in the next video.